Good morning, everybody, and I think good afternoon for those who are joining us in New Zealand. I think Sylvia and David, hopefully you can hear me.
Yes, we can hear you. Good morning,
Excellent.
Good afternoon, and good morning.
Good morning, good afternoon. So thank you for joining me for the second webcast or webinar that we're doing on Exposure Draft 315, and we will be discussing the exposure draft, which is all around risk assessments. My name is Fiona Campbell and I am a member of the IAASB. I'm also a partner with Ernst & Young in Melbourne, and I have the pleasure of chairing the task force on ISA 315. So just to recap the journey that we have taken so far, and for some reason my slides are on the go slow. The roadmap here that you can see is really just showing where we started from and where we're up to at the moment. So we had our project proposal approved back in September 2016, so 2 years ago, and trust me, it feels like longer than 2 years ago. And since we had the project proposal approved, we have spent the last just over 18 months working really hard on taking all of the feedback from the post-implementation review of the various ISAs and other feedback from other stakeholders around what some of the issues and challenges and problems were with ISA 315 that needed to be addressed and clarified. And that resulted in the approval of our exposure draft, which was at the June 2018 IAASB board meeting. So that got approved and is the standard that hopefully you are all responding to over the next few weeks. Currently, we're at that last yellow signpost on our journey, and that's the Q&A webinar that you can see there. We're going to talk through a whole suite of questions that we received before this webinar, and some of the questions are quite long. I apologise in advance, but we felt it was important for some of the questions to give the context that had come with the questions. But it does mean that we've used a little bit of shorthand in some of the questions, and I also use shorthand, I know, when I talk about some of these concepts. In particular, D&I, so evaluating the design of a control and determining whether or not it's been implemented. Shorthand for that is D&I. The significant classes of transactions, account balances and disclosures. Look, I don't even know how to say that last acronym, but I tend to go with Scalability, but I don't know if that's the right way to say it. But I'll try and spell it out longhand just to make sure that the acronyms don't overwhelm people. So thank you to people who sent in their questions for today's webinar, as well as there were a number of questions raised during the last webinar that I'm sure some of you joined us for. We've used all of those questions to create the Q&A slides that we're going to cover today. Please feel free as we go through the slides to raise more questions. I don't know that we will have time to answer them. Last night's webinar that I ran on the same topic at a socially unacceptable hour for us in this part of the world, but last night's webinar went for the full time allocation, so we didn't get time at the end. But it is still really important for us as a task force to see those questions, because what it will help us do is it will help us have some additional information to help supplement the responses to the ED, to try and identify where are the places that people are struggling to understand that maybe we think we've clarified, but we haven't in fact made them clear enough. And they'll also be important inputs as well to thinking about some of the implementation guidance that we might be able to develop. So in addition to the flowcharts and other materials that we released with the exposure draft, we're also thinking about what additional materials might we need to help with the implementation. So please raise the questions as we go. There were also a number of questions raised several times, so we've merged those questions into one question. So you might not recognise the exact words of the question that you raised, but hopefully your question will still get addressed. So that you don't have to just listen to my voice for the entire time, which will be quite boring, I am joined by Sylvia van Dijk from the XRB. Thank you very much, Sylvia, for joining. So Sylvia is going to be my able assistant and read out the questions. Sylvia is a technical advisor to Lynn Provo, who is IAASB member from New Zealand. So she is very familiar with ISA 315 exposure draft because she's had to read it many times in helping prepare her board member. So Sylvia, thank you very much for making yourself myself available this morning, and I won't say I'm volunteering because I think I volunteered you to read the questions, but thank you very much. So I will hand to you for the first question.
Thank you, Fiona, and good morning, good afternoon to everyone. So the first question, as you can see on the slide there now, ED 315 now has new introductory paragraphs setting out the key concepts in the proposed standard. Now, since these paragraphs are separate from the requirements, what is the authority of these paragraphs? That is, do these paragraphs carry the same authority?
Thanks, Sylvia. So these introductory paragraphs are really just trying to set the scene. They don't carry the same authority as requirements do. They're not requirements. They are really, as it says, introductory material to try and set the scene, to try and help you understand how, almost like in a simple 101 for risk assessments in 8 or 9 paragraphs, how do I understand how this is all going to hang together? But the responsibilities themselves are created by the requirements, which obviously follow these introductory paragraphs. So these introductory paragraphs are absolutely intended to be separate from the requirements, and they don't have any authority in inverted commas as such.
Coming on to the second question. Now, this is a long question, so just bear with us. In the explanatory memorandum and the project proposal, it says that the board did not intend to change the fundamentals of the audit risk model. The EM refers to scalability and consistency of identifying significant risks as the key areas where stakeholders felt the risk assessment model needed to be improved. The exposure draft, however, proposes quite significant changes to the risk assessment process, introducing new concepts, logic, and requirements that impose a much more directed thought process. Recognizing that changing the fundamentals of the risk assessment model will have a significant effect on methodologies and audit software, and therefore will potentially be disruptive with possible negative impact on audit quality, at least during transition, why does the board believe that this nature and extent of the proposed changes are necessary to address the issues that had been identified? Did the board consider alternative ways to address stakeholders' issues that did not involve fundamentally changing the risk assessment model in extant ISO 315?
I promise you that not all of the questions are this long, but I did think it was helpful to give some context to, really the real nub of the issue, which is the concern that this person has around the exposure draft proposing significant changes to the risk assessment model. We have not changed the risk assessment model. We still have the audit risk model being audit risk equals control, inherent risk times control risk times detect risk. So that definition, that's still the same. We still have significant risks which need to be identified, and they still have the same consequences once you've identified a significant risk. You still need to test controls before you can reduce control risk. All of that is in extant already. So we don't actually believe that the changes have changed the audit risk model. Instead, we've tried to clarify the existing requirements of the audit risk model. The board was very clear with us that we were not to change the risk assessment model. And so we spent a little over 18 months on a journey with the board, explaining and drafting and redrafting how we intended to clarify the various concepts, but we were not we certainly are not intending to, and I don't believe we have changed the risk assessment model. The clarifications have been explored thoroughly with the board and discussed with them, and initially, right back at the beginning of the process, there were concerns that we may have been sort of playing with the risk assessment model a little bit, but we pulled back from that and we've stayed with those same key concepts that have always been in the standard. So we don't think we've changed the risk assessment model, and certainly not as dramatically or significantly as perhaps what this particular question would suggest.
Next question. This is to do with scalability. The application material of extant ISO 315 revised included separate paragraphs on considerations specific to smaller entities. These paragraphs are not in the ED. What is the approach in ED 315?
So these two questions, I know we've got them separate and we tried to deal with them separately last night, but the answer actually probably molds into the two, so I might answer both of them at the same time. But I'll start with question 3. And when we were making the proposed revisions around scalability, we specifically removed what is in extant currently, those headings that say considerations specific to smaller entities. So we removed those throughout the standard. But what we did was we didn't lose the content that sat underneath them. Most of the matters that were previously included in those sections have been retained, and we've built them into the text of the application material as appropriate. We've also done some additional proposed revisions to try and promote additional scalability. Also, we noted that in some cases, the content that was in those extant paragraphs, considerations specific to smaller entities, wasn't actually unique to the audits of smaller and less complex entities. So we revised those as well to make them applicable so that it wasn't seen to be just for smaller and less complex entities that you could apply those considerations. We also thought about where we would place the guidance related to scalability, and we determined that having those paragraphs at the end of each of the sections of application material wasn't actually that helpful. And our SMP person on our task force made the suggestion that it would be helpful to have the scalability considerations right at the beginning to set the context for what you were about to read. So we moved and placed the guidance related to scalability in many places to the start of the relevant section so that you could, I guess, more appropriately consider the material that was about to follow in the context. It is also worth noting that this is application material only. All the requirements are the requirements and they are principles based. So the auditor is really needing to use their professional judgment as to how to apply those requirements to the facts and circumstances of the entity they're auditing. And that includes using your professional judgment around how to apply the requirements from a scalability perspective. So while we talk about smaller and less complex, how would you apply that to maybe slightly larger entities that are still less complex? And the way I think about it is smaller and less complex is one of the bookends of scalability. So small and less complex being the smallest entities and the simplest entities or least complex entities that we could ever audit. They're on one end of that scale. And at the other end, the other bookend would be the very largest multinational, really complex audits. And your audit will probably fit somewhere in between those two bookends. But what we've tried to do is build the application material for the smallest end, and then auditors will use their judgment to work out how much of that can I apply to the facts and circumstances of my client. So even though the guidance refers to smaller and less complex, you might have an entity which is slightly larger and still less complex, and these provisions in the application material might actually still apply to your circumstances and therefore be totally okay to apply to your slightly larger but still less complex entity. So it's not just about size, which is what the old heading used to talk about, where it said considerations specific to smaller entities. We felt that it wasn't just size. Just because you were small didn't make you an easy audit. You can have a large audit that's really simple to audit as well. So it was about size and complexity, and that's why we put the two concepts together. So we might just move on to the next two questions, if that's okay, Sylvia.
Yeah, sure. So I will take both of the next questions then. This is to do with definitions. Definition of controls. The new definition includes that controls could be implied through actions and decisions. Could these type of controls be identified as controls relevant to the audit? And the second question there is, what is the distinction between controls and application controls?
So yes, is the answer to the first question. We specifically tried to acknowledge in the definition that controls may not be formally documented in all cases, and that really was to allow for smaller entities, for example, that may not have documented the controls. Instead, you may be able to see those controls in existence through the actions that can be observed. And yes, these types of controls could absolutely be identified as controls relevant to the audit. So that was a specific consideration that we made in the definition. We also aligned the definition of controls with COSO, and this concept of controls that are implied through actions and decisions, that concept exists in COSO. So you know, we're fully trying to acknowledge here that these could be controls relevant to the audit, but we would have to at least observe these occurring, and then obviously other procedures as well. But that's absolutely our intention behind that definition and that question in question 5. For question 6, the distinction between controls and application controls. Controls, or the way I think about it anyway, controls is the overarching term for all types of controls that an entity puts in place. Application controls is a subset, it's a type of control. Application controls are the ones that operate at the application level. They're just one type of control. And 315 deals with application controls, general IT controls. Both of those are examples of types of controls that you would have. So application controls is a subset of controls.
Fiona, the next question deals with the definition of significant risk. So what is the relationship between likelihood and magnitude in determining whether any assessed risk of material misstatement is a significant risk? For example, for any relevant assertion, can the related risk of material misstatement be a significant risk where the likelihood of misstatement is towards the lower end of the spectrum of inherent risk, but there is still a reasonable possibility of misstatement that is material, and the magnitude of potential misstatement is towards the upper end of the spectrum of inherent risk?
The lovely significant risk definition. So technically, yes, is the answer to that. And this is one of the things that you may have heard me mention on the last webinar, that significant risk is really about likelihood or magnitude being considered when you identify if an inherent risk is a significant risk. And that word "or" in the definition was deliberate. There were some board members that felt that even though there was a really high magnitude, if it was maybe not a high likelihood, but there was still a likelihood, they felt that that should be treated as a significant risk. There were mixed views, it would be fair to say, when it came time to approving this exposure draft. But the decision had already been made, and we'd already gone through due process as a task force and as a board to land on requiring that word "or" to be in the definition. So you'll see we have asked a specific question on this definition. As I said, there are mixed views on the board, so we really wanted direction from the respondents to the exposure draft to work out whether the word should stay "or" in there, or whether the word should be "and." And there's a number of people, myself included, I'll disclose my personal views. My personal view is that the significant risks are the really, what I will call scary inherent risks, you know, right at that sort of top end. And from my perspective, I think it's about likelihood and magnitude, but that was not the view that the board took, and it was a majority view that was taken at the time that decision was made. So please, if you feel strongly about this particular definition and the consequences of this definition, then you need to include that in your responses to the exposure draft. So that's really the issue with significant risk.
Now turning to automated tools and techniques, which is a new term being used. So what is meant by the term automated tools and techniques, and how is this different from data analytics? I'm not sure, Fiona, would you like me to cover more than the other questions on this?
We might take these questions together just because they all kind of touch on the same concept of data analytics versus automated tools and techniques. So yes, please.
Okay. Then question 9. For purposes of the auditor's risk assessment procedures, what is the difference between the use of automated tools and techniques and analytical procedures in accordance with ISO 520 analytical procedures? Question 10. Does ED 315 require the use of automated tools and techniques when performing risk assessment procedures? And then 11, if the auditor uses automated tools and techniques, what is the auditor's responsibility in relation to the accuracy and completeness of the source data?
Thanks, Sylvia. So question 8, what is meant by the term automated tools and techniques? It is not different from data analytics, but it's more than data analytics. So we debated at a number of meetings now with the board what the term was that we should use. The Data Analytics Working Group, the IAASB, had already decided that data analytics was a term that was incredibly difficult to define and meant different things to different people depending on obviously the experience and mindset that you came at the subject with. So we felt it was important. I mean, data analytics is really just an automated tool or an automated technique for auditing, large volumes of data. So we use the word automated tools and techniques, but it is a broader concept than just data analytics. So for example, automated tools and techniques would include things like, robots, robotics that we are using to do bank confirmations and simple procedures, for example. It would include drones that are being used to perform stock takes. So we just need to just be mindful that these automated tools and techniques are broader than data analytics, but it absolutely includes data analytics. So in the application material, we do use the word data analytics, I think maybe once or twice, but we tried to stick to the broader tool, concept. When you're doing your risk assessment procedures, this next question around the difference between these automated tools and techniques and then the analytical procedures that you've got in ISO 520. The automatic tools and techniques are not just used for analytical procedures. They're also used, for example, for tests of detail. So the technique described in 520, it's the same technique as such in 315, but how you go about it might be slightly different. So for example, often the procedures when you're using automated tools and techniques such as data analytics are about looking for anomalies or risks or places where things can go wrong in large volumes of data. Whereas when you are performing analytical procedures in accordance with ISO 520, that can often be about corroborating a whole lot of other work or insights you've already gained during your audit. So they can be slightly different. It's a really fine line as well between when you are performing a risk assessment procedure and when you are suddenly gathering audit evidence in response to a substantive procedure. But that is something that that is, on the agenda for the IAASB to think about. Question 10 as to whether or not we require the use of automated tools and techniques. We absolutely do not require it. What we've tried to do is modernise 315 to recognise that many risk assessment procedures being performed are automated. So we're really just trying to recognise the changing environment. And we've made changes to the application material, recognising that the way the requirements are implemented by auditors may in fact be through use of automated tools and techniques, but it's absolutely not required. And then the last question, the responsibility around the accuracy and the completeness of the source data. And this is no different to what's already required in extant ISO 500. So you still need to think about the population on which your procedures are being performed. As I kind of just touched on briefly, the board does absolutely recognise there are a whole raft of issues that are being explored relating to automated procedures and particularly data analytics, and also audit evidence and how does that all link together. And so we are considering a project on audit evidence, ISO 500 in particular, but it will hopefully touch on a number of these issues that have been raised in this set of questions. So I expect you should see that on our work plan over the coming sort of 12 to 18 months.
Now, another new definition is that of a relevant assertions. So what is the relationship, if any, between reasonable possibility and more than remote and reduce audit risk to an acceptably low level? included in the definition of detection risk in ISO 200?
It is intended that remote possibility and more than remote mean the same thing. I know for those of us, English is our first language, and when you read it cold, you would think they sound a little bit different, but they are meant to mean exactly the same thing. For anyone who works on a PCAOB engagement, you'll be familiar with more than remote, because that's the phrase they use. And for those who only work on ISA audits, you'll be familiar with the phrase reasonable possibility. But all of the guidance and inspections and everything else that happens demonstrate that those two terms actually are interchangeable and mean the same thing. So the other thing I would just mention as well is reasonable possibility and more than remote are all about likelihood. But when you get to the sentence on reducing audit risk to an acceptably low level, there's nothing there that deals with likelihood. So my view is if something isn't reasonably possible, then your audit risk is an acceptably low level. And that's kind of how we designed it to try and make those two things mean the same. But if you don't have a reasonable possibility, then you've already got your audit risk at an acceptably low level where you then don't have to do any more work.
Okay, now turning to the inherent risk factors. What I'm going to do is just read all these questions again, Fiona, and then you can answer them all in one go. So question 13, what is the purpose of the inherent risk factors? Why are the inherent risk factors in ED 315 different to the inherent risk factors in ISO 540 revised? So please clarify how the inherent risk factors affect the auditor's understanding of the applicable financial reporting framework. And then the last question here is, the ISA introduced the concept of inherent risk factors, one of which is that an account balance, class of transaction, or disclosure may have a quantitative inherent risk factor. This would imply that all large account balances, classes of transactions, or disclosures would have a level of inherent risk associated with them, which would appear to contradict the concept of a material-only account balance, class of transaction, or disclosure introduced in paragraph 52 of the proposed standard. Please clarify how this should be interpreted.
Thanks, Sylvia. So inherent risk factors, or IRFs, as I have nicknamed them, they are intended to help the auditor in focusing on those aspects of the events or conditions that affect an assertion susceptibility misstatement. And that in turn helps the auditor make a much more focused identification of the risks of material misstatement. So taking into account the degree to which those inherent risk factors affect your susceptibility to misstatement also assists, in our view, in the assessment of inherent risk. And the IRFs are first contemplated when the auditor thinks about the application of the financial reporting framework. So that's sort of 13 and 15 kind of connect them together, but I will just cover off quickly the differences between 540 and 315. They aren't actually different. What we have is the overarching inherent risk factors are in 315, and then when you get to 540, which is all about auditing estimates, they only have the inherent risk factors that are relevant to ISO 540. So they are much more specific. So for example, we use the phrase uncertainty as an inherent risk factor in our standard. They refer to it as estimation uncertainty. So it's still uncertainty, but in 540 it's estimation uncertainty, because what their standard is focused on is auditing estimates, and therefore the estimation uncertainty is the inherent risk factor sort of sub-piece or component that is important. The inherent risk factors were intentionally made consistent. We worked very hard, the two task forces together, to make them consistent. And we also worked really hard to make sure that they looked, or they were as consistent as possible with the terms used in the exposure draft for auditing estimates that the PCAOB released last year as well. They have slightly different words that they use, but we do believe the terms and the meaning behind those terms are reasonably aligned between 315, 540 and the PCAOB exposure draft that they had. So we don't believe that they are different. In terms of the inherent risk factors affecting your understanding of the applicable financial reporting framework, I mean, this could be thought about both ways. You could start with identifying your inherent risk factors and then thinking about it in the context of your financial reporting framework. We could think about it the other way and start thinking about your financial reporting framework and then identify the inherent risk factors as a result. So for example, if you know that your financial reporting framework is IFRS, for example, and you've got lots of intangible balances on the balance sheet, then it's possible you've got some complexity in how you account for those intangibles, and therefore you would have an inherent risk factor which would lead you to think about maybe the valuation of those intangibles assertion, and that might be a higher inherent risk, or in fact it might even be a significant risk depending on the level of complexity that IRF brings to it based on your understanding of the financial reporting framework. I don't think that this is necessarily a totally new concept. I think most auditors, when they pick up a trial balance or they pick up last year's financial statements and look at them, they look at them with the mindset of where could all the risks be, where could all the things go wrong, what are the inherent risks here in this set of financials, and it's based on the set of financials you're going to be giving an opinion on, so that financial reporting framework. So question 16, I think this question, perhaps the person has got a little confused between when we're talking about significant accounts and when we're talking about material only accounts. And the material only accounts, this is an issue we were asked to specifically deal with, which was outside of ISA 315. This is in ISA 330 and it's paragraph 18 specifically. And just to paraphrase what that standard is saying, it's basically saying, irrespective of the risk assessment you get to under ISA 315, if you get to 330 and you've got a material balance, class of transaction or disclosure, then you need to perform some substantive procedures on it if you haven't already done so. And so it's effectively almost ignoring the risk assessment procedures you've done in 315, saying, well, if it's really big or it's qualitatively material, you still need to do some work on it. So what we were trying to do by putting in paragraph 52 and having this stand back is to try and identify before you get to 330, while you're doing 315, do we have any of these balances which are material either quantitatively or qualitatively that you didn't already identify as significant, because you'll still have to do some procedures when you get to 330 on them. So we'll talk a little bit again about this in another question, but really that's where the concept between significant and material was trying to be distinguished, and really the initial identification of what you're doing here using the inherent risk factors is to identify significant account balances. It's not helping you identify the material only ones, if that makes sense.
The next question, question 17, is on risk assessment procedures. Now, the proposed standard uses the term sufficient appropriate audit evidence in the context of the risk assessment procedures. Now, we know that this term has a specific meaning in the standards. Please, could you explain how this would be implemented specifically in the context of paragraph 6 of ISA 500?
Extant 315 requires that risk assessment procedures are performed to provide a basis for further audit procedures. So that's probably the language that you're all very familiar with. That's not linked explicitly to this concept of audit evidence. So it's instead you're doing stuff to provide a basis for trying to work out what else you need to do. However, you need audit evidence to be able to explain the basis for your further audit procedures once you get to ISA 330. And therefore, this link to audit evidence, we felt needed to be more explicit. And where it comes out is actually in another standard, which is in ISA 500, but it's actually application material A10. And I'll paraphrase, but essentially there's a heading above that paragraph called Audit Procedures for Obtaining Audit Evidence. And it says, as required and explained further in ISA 315 and 330, audit evidence to draw reasonable conclusions on which to base your auditor's opinion are obtained by performing risk assessment procedures and further audit procedures. So that's your test of controls and your substantive. So our view was that there's a very clear link, which was important to clarify in 315 as to why you needed to do all of these risk assessment procedures in 315. You need to do them because you actually need to be able to show that you've got sufficient appropriate audit evidence after you've done all of your risk assessment procedures and then also all of your other further audit procedures, which are your test of controls and substantive procedures. So that's why we have changed the term slightly to include this sufficient appropriate audit evidence, but it hasn't actually changed what's already in the extant standards. We've just made the link much more explicit.
The next question deals with understanding the system of internal control. Now, one of the key areas in the extant ISA that practitioners felt required clarification was the question of how much is enough in obtaining an understanding of controls, particularly in relation to the control activities. This is key to scalability and efficient and robust audits. The overriding aim has now been set as needing to obtain sufficient understanding to have sufficient appropriate audit evidence. Yet it seems open-ended and circular, given that paragraph 39E imposes a judgment on the auditor to identify and evaluate those controls that, in the auditor's professional judgment, are appropriate to identify and assess the risks of material misstatement. It is not clear the basis on which the auditor makes that judgment, yet it seems critical to the determination of when the auditor has obtained sufficient appropriate audit evidence as a basis for the auditor's risk assessment. Can you explain how the proposed revisions provide the needed clarification of how much understanding is needed?
Thanks. So yes, one of those other really long questions, and I think there's probably one more still to come. It does feed in quite closely to the previous question as well on 18. So our goal for 315, or one of the many goals, but it was to try and clarify that the auditor has to perform risk assessment procedures that are sufficient to allow the auditor to be able to respond in accordance with ISA 330, and then obviously the same applies for controls. And the amount of work needed to determine this is professional judgment. And I know nobody likes that as an answer because you'd like a black and white answer, but that's the reality. A lot of professional judgment is going to be needed to determine this as to, you know, how much is enough. But many of the changes we did make in the ED are to try and help the auditor understand the matters that need to be understood. So especially the indirect components of internal control. Regarding controls relevant to the audit, I mean, again, professional judgment needs to be used on the nature of the control. It's very hard for us to be prescriptive in a standard, particularly in relation to those that the auditor is determining, are relevant based on their judgment. It depends on the nature and the circumstances of the audit, and in fact, the auditor may need other controls to help determine what the right audit approach is. So I guess my shorthand version of this is basically the goal for 315 is for auditors to do all the risk assessment procedures they think they need to do to be able to then move on to ISA 330. So that is, do enough work to be able to be ready to design your responses, and to be able to design audit responses, you need to have an understanding of controls relevant to the audit. That's our view, is that designing responses in 330, so coming up with what your substantive audit program is going to be, can only be done properly if you understand the system of internal controls and the controls that might be in place.
Another question on the system of internal control. Fiona, if the auditor knows they want to take a fully substantive approach to the audit, why is it necessary to obtain an understanding of the components of the system of internal control?
This is a really popular question and gets raised all the time. So even though it didn't get raised for this particular Q&A, it got raised at the previous webinar, I would say 30 or 40 times. So we absolutely felt we needed to include this question. In short, extant already requires you to do these things, and to remove the requirement to get this understanding of the system of internal control, we felt would be weakening what's already in extant 315. The requirement to get this understanding of the components of the system of internal control was 100% supported by the board and many other stakeholders we spoke to. There was no appetite to remove that need to get this understanding on all audits. And believe me, we tried. We tried really hard. We even tried as a compromise position to suggest that some components out of the 5 are not always relevant to the audit, but the board would have none of it. They were not supportive of that at all. And really what it boiled down to is that it's really important to understand your components of the system of internal control, because that helps you inform how you're going to respond to them. And also what it does is it helps inform you whether you have financial statement level risks as well. And that obviously feeds into impacting nature and extent of the substantive procedures that are required. So for example, if a company has no controls or they're just a total disaster, then you would need to know that, because you'll need to do more substantive work and you need to know where you're going to be designing that substantive work. And you can only know that if you've got an understanding of the system of internal control. So how much of that understanding you need to get, that's obviously professional judgment, and we've tried to clarify that with not the flow chart, but directly behind the flow chart there's a page which some call a flow chart, which shows the 5 components and exactly what you need to do. So that's a matter of judgment as to how deep do you dive into each of those 5 components to get enough to then be able to move into 330. But certainly you can't go straight to designing your substantive approach, in our view and in the board's view, unless you've understood these components.
Moving on to the control environment. Now, can the auditor obtain the required understanding of the control environment through inquiries only? So if we look at paragraph 36 of the explanatory memorandum, it states that the nature, timing, and extent of risk assessment procedures are matters of professional judgment and based on the auditor's determination as to what will provide sufficient appropriate audit evidence for the basis for the identification and assessment of the risks material misstatement. Paragraph A108 of ED 315 states, audit evidence for the auditor's understanding of the control environment may be obtained through a combination of inquiries and other risk assessment procedures.
The short answer to whether or not an auditor can obtain the required understanding of that control environment through inquiries alone is no. What we have done is, for the various components, we've tried to make it clear that inquiry alone is not sufficient. So I think it's paragraph A116 for the entity's risk assessment process and A153 for understanding the system of information control. So the reference in that second bullet point for A108, where it says it may be obtained through a combination of inquiries, that word may was not meant to limit the gaining of the understanding to inquiries alone. And in fact, when you get to ISA 500, there's a paragraph A2 which makes it really clear in our view that inquiry alone is not a procedure on its own and you have to supplement it by other procedures. And that paragraph is saying that most of the auditor's work consists of obtaining and evaluating audit evidence, and audit procedures to obtain that audit evidence can include inspection, observation, confirmation, recalculation, reperformance, and analytical procedures, often in some combination, in addition to inquiry. So that last little part of that paragraph, in addition to inquiry, is we felt really clear that inquiry alone is not enough.
Moving on to a question on information system and communication now. ED 315 paragraph 35 requires the auditor to understand how information relating to significant classes of transactions, account balances, and disclosures flows through the entity's information system. However, the auditor only determines Scalability, I'll use Fiona's pronunciation there, and their relevant assertions based on identified risks of material misstatement in accordance with paragraph 46 of ED 315. The question is, please clarify the nature and extent of the determination of significant classes of transactions and balances and disclosures for purposes of paragraph 35 of ED 315.
This is a prime example where the iterative nature of what you do when you're performing a risk assessment doesn't really work when you're having to write a standard in a very linear way. And what we've done is we've tried to recognise that by adding some application material. So in paragraph A141, we talk about risk identification and assessment being an iterative process, and that the auditor's expectations are formed in paragraph 23 about all of these classes of transactions, etc. And that may help the auditor in working out which ones of them are significant when you get to paragraph 46. And they're those that need to be understood when you obtain your understanding of the information system in accordance with paragraph 35. So it goes 23, 46, 35. And I know we're all auditors, those numbers don't flow logically, but the reality is that's kind of how we had to write it to get through all of the 5 components of internal control before you then take what did I learn to help me determine which ones are significant. So for example, the auditor may have an expectation that there are certain significant classes of transactions related to revenue, for example. And then when you get your understanding of the flows of information in the information system, so in this particular component, you actually may identify there are additional classes of transactions related to revenue that are also significant. So it is really important for you to, it doesn't matter which way you come at it, whether you start with your Scottibies first or whether you just start with a kind of an understanding or a gut feel of what you think the important ones are going to be. That understanding the flow, how do the debits and credits flow through the information system is really important, because it does hopefully confirm what you already thought, but also will identify if maybe your thinking wasn't quite right and there are in fact some additional significant flows that you need to understand as well. And if I think about a recurring audit, you're most likely to start with your significant or your Scottibies to start with, because you know what they are from last year. And so the flow probably works much better for an audit that's not a first year audit, and obviously most of what we do are not first year audits. So the flow probably works because you already have an idea of what those Scottibies are going to be. And then even on a first year audit, I mean, if I think about some of the first year audits I've worked on, you have expectations as to what the significant ones are going to be, even before you get too far into your understanding of all of these components of internal control. Even before you've started understanding the flow of debits and credits, a lot of partners and managers and senior managers can pick up a trial balance or a set of financials and can tell you where are the significant accounts, where are the significant classes of transactions, and what are going to be the significant disclosures. So while it's written in a linear fashion, I think the practical or pragmatic way that auditors do this is not following paragraph 23, then 24, then 25 in a linear fashion. I think you tend to jump around a little bit, and that was certainly what our intention was, not to make it confusing. Our intention was to try and, we had to write it in a linear fashion, but to try and illustrate by using these flow charts and other things that it's actually a very iterative nature, and you don't have to start at number 1 and finish at number 50. You go in the order that makes most logical sense for your audit.
So another question on the information system and communication. Now, paragraph 36 of the proposed standard requires the auditor to evaluate the design of the information system controls relevant to financial reporting by understanding how information relating to significant classes of transactions, account balances, and disclosures flow through the entity's information systems. Now, is this requiring the auditor to evaluate the entire information system, including the business processes for all identified risks? and the auditor to understand controls for every significant class of transactions, account balance, and disclosure?
The auditor needs to understand the flow of information for all of the significant account balances, classes of transactions, disclosures. So it's the flows that relate to what is relevant to the financial reporting. It's the flows of information that need to be understood, not just the control. So it's the debits and credits. Where's the initiation of the transaction? Where does that start, and then where does it end up in the general ledger or the trial balance? In terms of scope, how much of the information system do I need to understand? It's only those that are relevant to the flow of information relevant to financial reporting. So if I think about, I've got a significant class of transaction being revenue, then I would absolutely need to understand the flow of the transaction, so the debits and credits that relate to that significant class of transaction. But it's not the entire information system, including everything. It's only in the context of the relevant financial reporting that you're concerned about it.
Fiona, what is the difference in the work effort between ED 315 paragraph 36, which is evaluating the design of information system controls relevant to financial reporting by understanding how the matters in paragraph 35A to D are addressed by the entity and implemented, and ED 315 paragraph 42, for each control identified as relevant to the audit to evaluate the design and implementation?
Paragraph 36 relates to obtaining and understanding of the information system, so the flows of information through the information system relevant to financial reporting. And we've included some application material in A153 that explains the risk assessment procedures to obtain that understanding. And then A154 explains the audit evidence you obtain from those procedures is used to perform your D&I. So effectively, it's explaining how to do D&I for the purposes of getting that necessary understanding. That's what 36 is all about. Paragraph 42 relates to the control activities component. So that's a different component out of the 5 components in your system of control. So these are the controls relevant to your audit. And paragraph A194 right the way through to A199, they explain how that would be done. So, and then paragraph A200 explains, or is trying to help the auditor with, further things to think about in addition to having obtained your understanding. So the D&I here is of the controls that you've identified as relevant to the audit, which are in the control activities component. So paragraph 36, just to recap, is really confirming your understanding of the flow of the information, so the debits and credits, and 42 is where the controls over that flow are evaluated. Now, we call them different things because the work effort is different. What you have to do to get your understanding of the debits and credits is different to doing the D&I on the controls. I mean, practically speaking, I don't think it matters which paragraph you're in. I think a lot of auditors, when they're getting an understanding of the debits and credits, they're also identifying controls relevant to the audit. So they do this all kind of in one big sort of jumble. I personally don't think it really matters which of the 2 components you're in, but obviously from a standard writing perspective, we had to write them as 2 separate paragraphs.
Fiona, is it possible to not have any controls relevant to the audit? And if so, what impact would this have on the rest of the audit?
No, it is not possible to not have any controls relevant to the audit. You will always have journal entries, and it's likely that you'll have at least one significant risk. I do understand there are entities with no significant risk. I mean, that's rare, but so you definitely have journal entries, and you would potentially have significant risks, and you need to do the D&I on controls of those 2 at least. I think the requirement for journal entries is already in extant, and the controls related to significant risks is already in extant as well, so those are already required. The journal entry one was at a very funny place, so I think a lot of people didn't really understand that means your journal entries, you should always have controls related to those journal entries, otherwise you're going to have an awful lot of substantive testing to do. So we felt that extant already says there will always be controls around journal entries. Whether or not they're effective controls and you can test them for effectiveness is different, but you at least need to do D&I on them. And in terms of the second part of the question, well, I guess it's not really relevant because the answer to the first one is no, you can't have it. But once you've dealt with your journal entries and maybe a significant risk, then the rest of your audit is really going to be focused on doing lots of substantive testing and no test of controls, essentially. That's what the impact is.
Dealing now with a question on D&I of controls. Now, paragraph 39E indicates that it's in the auditor's judgment to identify and evaluate D&I of controls when it is needed to identify and assess risk or to design further audit procedures. The application material is focused on how that would benefit the auditor in designing further audit procedures. Therefore, could you please explain how identifying controls and evaluating the D&I would identify risks of material misstatement? Could you also please explain how identifying controls and evaluating the D&I would assess risks of material misstatement, other than control risk for assertion level risks of material misstatement? And then thirdly, could you provide a common situation when it would be appropriate not to identify and evaluate D&I of controls under paragraph 39E, given that the wording in the requirement says it can assist in identifying and assessing risks of material misstatement?
So, understanding design and implementation helps the auditor to better understand what the risk is that management are trying to mitigate by putting those controls in place in the first place. So management don't just create controls for no reason. They do it because they're trying to mitigate a risk. They're trying to respond to some kind of inherent risk. And so we think that by understanding those controls, in particular how they're designed and whether they've been implemented, that absolutely helps the auditor identify where there are risks. So if you haven't already identified the risks just because you're smart and you know what the risks are, by understanding the controls management have put in place, that will help you identify risks. By performing the design and implementation of the controls, that helps you understand the nature of the risk, which we believe helps with the assessment of the risk. So if a control is relevant, then obviously you're required to do design and implementation on it. And paragraph 39E is getting you to use judgment as to whether or not there are other controls relevant to the audit, which I've talked about earlier. So there's a requirement for D&I. If you do identify other controls, obviously, the main objective is to, if we stand back from all of this, the main objective is to get a basis for the responses to your assessed risk and material misstatement when you move to ISO 330. So if you think you have enough information on the flow alone to go to 330, then you don't have to go looking for and adding, lots more controls or identifying more controls relevant to the audit. There's no requirement to go looking for the controls, but if there are controls relevant to the audit, you then need to do D&I on them.
Now turning to control deficiencies. In a primarily substantive audit approach, the identification of controls relevant to the audit may be limited, and accordingly, the auditor may not identify any control deficiencies within the system of internal control. Is there an obligation on the auditor to perform additional work in order to identify control deficiencies? For example, such as missing controls, based on the requirements of ED 315, paragraph 43?
No, there are no requirements to go looking for them. If you found them, obviously, if you found deficiencies, then you need to consider the impact on your audit if you identified them, but you don't need to go looking for them.
Okay. Now consider the following scenario. The auditor adopted a substantive audit approach and therefore did not perform any tests of the operating effectiveness of controls. The auditor identified controls relevant to the audit and performed D&I in accordance with the requirements of ED 315. the auditor did not identify any control deficiencies in accordance with paragraph 43 of ED 315. Questions. How does the scenario affect the assessment of control risk in accordance with the requirements of ED 315 and extant ISA 315? Secondly, what are the objectives or benefits of identifying controls relevant to the audit and performing the related D&I procedures?
This is a question we get asked a lot as well, is I want to jump straight to substantive approach. Why on earth do I care about anything to do with controls and doing D&I on them? So just to answer the first question first is, how does that scenario affect your control risk assessments under the ED versus under the extant ISA? There is nothing different. So how the person has set out this scenario is exactly the same under ED 315 as it is under extant 315. What we've done is we've made it crystal clear now that you can't reduce control risk unless you've actually tested the operating effectiveness of the controls. The intention is in extant, but we felt it maybe wasn't clear enough, and given some of the reactions we've had on a number of outreach programs, I expect we've made it crystal clear and people have not been applying it properly under extant 315. There's not a lot of guidance in how to do this in extant 315, and that's why we've enhanced this exposure draft 315. And what we did, there's one particular board member who regularly raised, well, when I get all this understanding, it has to impact my audit approach. I understand all of these things about controls and I've done D&I on them. Why can't I take credit for that? And the view of the board was a resounding, you can't take credit for controls unless you've tested them. So what we did was we added a paragraph which we nicknamed his paragraph, which is A200, and that sets out the benefits of why do I do the D&I? Why do I even bother getting this understanding and then doing D&I? And there's kind of three main reasons that we think you should be doing, or the benefits of identifying these controls and then doing the D&I on them is it helps work out your strategy for testing. So are you even going to bother testing the operating effectiveness of controls? Well, you can't really make that decision until you understand what controls are in place. Because you're understanding the risks that the controls are designed to respond to, it also helps the auditor with identifying the risks. So I see that earlier on one of the previous slides as well. This is really connecting, why did management put these controls in place? And therefore, what are the risks that you're identified that you're responding to? And the other thing it may also help you with is identifying risks at the financial statement level. For example, when you have expectations about how a system of internal control will operate based on your client acceptance procedures, when you get the understanding of the system of internal control and these pieces to it and it doesn't match up or it doesn't operate in that way, then that may also indicate a risk of material misstatement at the financial statement level. So that's why we think getting an understanding of these controls and doing D&I on them is important.
The following three questions on this slide deals with controls relevant to the audit. Question 28. Are there circumstances where D&I procedures are sufficient to test the operating effectiveness of the related controls? Question 29. Is there an expectation that the auditor will always identify IT applications relevant to the audit and general IT controls relevant to the audit? Question 30. ED 315 paragraph A181. When an entity uses an IT application that is reputable, widely used and considered reliable, is unable to change its programming and maintains hard copy accounting records, the auditor may determine that there are no IT applications relevant to the audit. How does the auditor assess reputable, given that very well-known software vendors have released software that did not operate as stated or expected?
D&I on its own is not enough to test the operating effectiveness of a related control, and we've tried to make that, again, crystal clear in the standard. However, there's obviously an exception to that. If it's an automated control, because obviously when you're testing the design and implementation of an automated control, you've already tested it to know that it's in place, so you've effectively done operating effectiveness. But clearly you still have to test the general IT controls that support that application control. But generally speaking, the answer to that question is no. Is there an expectation the auditor is always going to identify IT or general IT applications relevant to the audit? No. But I'd have to say, if you think about today's environment and the use of IT, I think it would be unlikely. Possibly when you have a really small entity using off-the-shelf package, I think we use the term commercial software in the exposure draft, but you still have to think about it. You still have to think about the IT that they're using. Have there been program changes to that IT? Maybe they can't change the executable file, so that's not possible. But are there access controls in place to make sure the right people are accessing and doing the transactions? So I think in today's world, we really should not be auditing around the system. Now, you obviously got to balance the need to perform procedures that are appropriate to the size of your entity, but I do think that really we shouldn't be auditing around the entity. And the last point on, when you've got an IT application that's reputable, and if I think of, MYOB and Xero and a whole range of ones that are widely used and considered reliable, it's not that you can just blindly use it and not think about it. You do have to think about whether or not you've got some concerns that there may be some risks arising out of IT. And if you genuinely think, look, you know what, my client's got a brand new version of this software, it's untested, we don't know if it works the way it should be working, then you might want to do some substantive procedures just to confirm it is operating the way that you think it should be operating. It is possible, though, that you could still determine there are no applications relevant to the audit, but you've got to remember, if you say that, anything that comes out of the system has to be audited substantively, and that's quite a lot of work. So I think in general we should not be avoiding IT, we should be taking it head on, and we should be thinking about what are the risks arising out of IT that the entity is using. And in small, less complex audits, I actually don't think there's a lot of risks necessarily. I think we just have to think about maybe the general IT controls that are in place to manage that software that they're using. And this is the last really long one, so I apologise. And in fact, Sylvia, I might just summarise this one for you because it is a bit of a long-winded one. But it's really trying to ask a question around when you're defining your risk and material misstatement at the financial statement level, and then linking that through to obviously the 200 explanation where it's talking about you've got one component at the assertion level. And so we have financial statement level risks, we have assertion level risks, and then what they're saying is the proposed risk assessment is asking the auditor to identify the risks of material misstatement and whether they exist at the financial statement or the assertion level. So I think the word "the" that has been underlined, or "the," depending on which part of the world you come from, I think they've overly focused on that word "the." And I think it would still work if you took the word out. And it's asking the auditor to identify risk of material misstatement to work out whether they exist at the financial statement level or at the assertion level. So that's the first comment I will make. And then the question goes on to really focus on, which way am I thinking about this? Am I coming at it from identifying significant classes of account balances and disclosures, which you have to have made a view on reasonable possibility, or do you start thinking about risks first? And it is reasonably circular, so I apologise for that, but I don't know how else to write it in the standard. Our view is it doesn't matter if you identify risk first or if you identify your significant accounts first. They're effectively joined at the hip. So some people start with working out what the significant accounts are first, and based on the significant accounts, they think about maybe what could go wrong and therefore where the risks might be. Others, however, start with identifying the risks first and then using these to help work out what my significant accounts might be. So this standard is meant to give that flexibility, and I know different firms have different ways of doing this. Some start with significant accounts first, some start with a whole suite of risks, and then you map those risks to the significant accounts. It was not meant to be prescriptive. We're not prescriptive in the order, and we've tried to explain in the application material A202 that it is iterative and the auditor can come at this in different ways, but that you think about the account, class of transaction and disclosure, you think about that in parallel to when you're thinking about risks. And then obviously significant accounts are identified to try and help make sure that you've got all of the risks and you've connected them all together.
Well, thank you for summarising that question so well for me, Fiona. Question 32. In determining the risks of material misstatement at the assertion level, is the expectation that the account balances and significant classes of transactions be identified at the trial balance level or at a financial statement line item level?
It's not prescriptive, and you're going to need to use your professional judgment. And what you're really trying to understand is how the risks in the accounts tie together. Now, this is this whole issue of disaggregation. To what level do you disaggregate to? And my view is that you would disaggregate to where the risk lies. So where are the risks all different? And then where are they the same? So if you need to disaggregate revenue, for example, to be multiple revenue accounts because they've got different risks, then that's what you would do. And this is where that understanding of the information system helps. It helps you understand the various systems that are feeding into the balances and perhaps whether or not you need to disaggregate. And that's why, as another reason why getting this understanding of that system of internal control is helpful, because it does help you understand, well, where are these risks coming from? Where are the flows of information coming from? And therefore, what level would I disaggregate to? But you certainly don't want to disaggregate to the level that nothing is a significant account balance. And there will be some instances where the financial statement level line item or disclosure is the level that you would do it at. You wouldn't disaggregate it at a lower level, but that needs to be your professional judgment as to what level you would drop down to.
Now, Fiona, this proposed standard introduces the concept of a spectrum of inherent risk, which allows the auditors to categorize the risk of material misstatement somewhere along that spectrum. Now, paragraph 822.25 indicates that those categories may be described in a numerical way, for example, a scale of 1 to 10, or actually by high, medium, low, where they're placed on that spectrum. Now, the question is, did the task force perform any outreach to determine if a scale of 1 to 10 is a method that has been or could be practically used by firms? And if a relative placement method is used, how would this differ from or drive change for those firms that already use a relative scale? For example, those existing methodologies that use those categories of low, elevated, and high.
We didn't perform specific outreach, but every time I did do outreach, this came up and people were saying, are you now telling us it's a number 1 to 10, or are you telling us it has to be high, medium, low, or is it a 9-box model or a 3-box model or a 12-box model? This is an example only. Your firm will already have a methodology that somehow works out where risk lies on a spectrum. So for some, it will be maximum, moderate, low, minimal. It might be high, medium, low. It might be a scale of 1 to 10. The scale of 1 to 10 was an example used by a small firm that they used, a scale system. But it's an example only. You would use whatever scale you already have. So this isn't a new concept. We've just tried to put some words around it to give it a term, which is spectrum of risk. And so however you already describe it, I would expect is totally fine under this, because everybody already thinks about risk being somewhere on a scale. This one's also a particularly long one, so I might have a go at trying to summarise this one as well for you, Sylvia, because it is a bit of an ugly one as well. And this has all come about with this need to do a separate identification and assessment of inherent risk, and then you need to obviously think about controls and assess your control risk as well. So currently under the ICES, you're allowed to do a combined risk assessment, or you can do a separate assessment of inherent risk and control risk. And the board discussed for a long time about what did those two things mean, and we couldn't actually find anyone who truly did a combined risk assessment. What we think they did was simultaneous assessments, but when they put the two pieces together, they were taking credit for controls that they hadn't actually tested. So just because they'd gone and got this understanding and tested the D&I, they felt that overall, when I combine all of that with my understanding of the inherent risk, I've got a lower overall risk. And so the board felt really strongly that we needed to take away the opportunity or the option for auditors to do this combined risk assessment. Instead, you have to do the two pieces separately. And assessing control risk isn't about trying to measure control risk as such. The key point we're trying to make here, and why it has to be described differently to inherent risk, is we're trying to make a decision: are you going to rely on controls or not? And if you're going to rely on controls, then you reduce your control risk, assuming they're effective. But it's different to inherent risk, which is why it's described differently. So you can identify all the inherent risks in the world, and you can assess where they fit on that spectrum. And you can identify where all of the control risks, or where all of the controls are that respond to those risks, and then decide if you intend to test them and therefore reduce the control risk. And that's why we included a graphic which was released at the same time as the flowcharts, which has a little square box which is really trying to explain the side-by-side identification and assessment of inherent risk, and then identifying your controls, and then deciding if you intend to test them. So you don't actually identify control risk, you identify controls, and that's why the two have to be described differently. And that's, I think, where this person has got a little confused with when they've read it, and maybe we need to do a better job of trying to explain that. But certainly the intention for this question is, they are absolutely right. We are not giving an opinion on controls, and what auditors are really doing is, I've now decided I've understood inherent risk. I'm now going to work out what my response is going to be and whether I bother testing controls. And that's exactly what we're asking you to do, is identify your inherent risk and assess it, and then identify the controls that respond to that and decide if you intend to test them.
Question 35. Now, the proposed standard introduced a new definition of significant risk. What does the task force believe will be the impact on the number and type of risks that are identified by auditors as being significant risks? And has consideration been given to the impact on audits of group financial statements, where one or more of the components are located in jurisdictions where the definition of significant risk remains the same as that in the extant ISA 315 revised?
Thanks, Sylvia. So, as I mentioned earlier a couple of times now, I think there's going to be more significant risks identified just because of this word "or" in the definition. I just think that's the reality of it. I think if we think about then the impact from a group perspective and timing, we already have this issue when a standard is revised and issued. Not every country in the world adopts it on the same timetable. So while the group and components element of it is going to be considered by the ISA 600 project over the next sort of 6 to 12 months, practically speaking, I would expect primary teams to communicate or instruct their local teams in the components of the difference. So if you are doing a group audit and component team is using the new definition of significant risk, they would need to communicate to the component teams as to what the new definition is, and therefore what the consequences will be for their audits. But that issue exists now. We have that problem now with the timing of when certain standards get adopted globally. And of course, this is all under the presumption that the significant risk definition changes to what we've got it in the proposed definition for. And in fact, that may not happen.
Now, the following questions deals with the standback requirement in ISA 330, paragraph 18. Why is it necessary to use the terms quantitatively or qualitatively in the context of materiality? Does it not already include both aspects? Question 37, could you please provide an example of a class of transaction, account balance or disclosure that may be quantitatively or qualitatively material but may not be identified as a SCOTA bead? For an account balance that is not identified as a SCOTA bead, but is quantitatively or qualitatively material, what is the nature of the required substantive audit procedures? For example, do the substantive procedures have to address all the assertions? And then question 39, paragraph 52 of the proposed standard introduces the concept of balances that are material only. Please, can you clarify whether the expectation is that this assessment is made at the financial statement line item and disclosure level?
Thanks. So this is the issue with paragraph 18 of 330 that we specifically were asked to include in our project proposal. And it's we think it's necessary to try and clarify what is meant by this concept of materiality. Materiality is a concept we all know and love as belonging to the conclusion we make at the financial statement level, but unfortunately that's not the context that it's used in 330.18, and we weren't given the mandate to change that, but we were given the mandate to try and clarify and link better 315 and 330. So the problem we're trying to fix is that if you didn't identify it as significant, it may still be material, and therefore 330.18 is going to say you have to do some procedures on it. And so that's why we've included quantitatively and qualitatively. And if I give you an example of what that would be, often on audits what I see is there would be an account called land, for example, and it could be a really big number, but it's not a significant account. There aren't assertions that I'm particularly worried about. Land is land. It never changes every year. It is what it is. When you get to 330.18, it's a big number. It's a qualitatively material number. Therefore, it would be captured as one of these material accounts that you need to design some procedures for. An example of one that is not necessarily a big dollar item, but qualitatively material is a related party transaction. So they would be the sorts of things that, excuse me, may not necessarily be captured as a significant account when you're working through 315, but this kind of don't forget about us reminder in 330.18 is there to make sure you don't forget about them. So we've added a stand back requirement into the standard that tries to get auditors to stand back once they've done their risk assessment and say, is there an account balance that I should have identified as significant that I haven't? So we have a question in the explanatory memorandum which is asking specifically about this stand back requirement and the interaction with 330, and do I need both of them? Or if auditors truly did a proper risk assessment, then in theory you wouldn't need 330.18, but I'm not sure that regulators and a number of other stakeholders will let us get rid of 330.18 yet. But if that's your view, then by all means put that in your response. In terms of what do I do then once I've got one of these balances that I didn't say was significant, but I've identified it as being material, and if I use the same example of land, I'm probably most concerned about whether or not I still own the land or is it valued properly. So I would design a substantive procedure to test that. It's unlikely I care about cut-off or completeness of land, so I wouldn't design procedures to respond to those assertions. So we've added in some application material to try and help explain what we mean by that. And it's really going to be a matter of professional judgment as to whether or not this is going to be made at the financial statement level line item or at the disclosure level line item. You need to think about where the risks are.
The following questions are on documentation. So what are the nature and extent of documentation requirements in relation to the inherent risk factors when obtaining an understanding of the financial reporting framework and identifying and assessing inherent risk, and identifying and assessing risk of material misstatement? And also, what is the documentation requirements of the standback requirement? There are some concerns that this requirement implies documenting the reasons why auditors did not identify any inherent risks, whereas it may be highly judgmental in many instances.
Documentation is a really vexed issue because I know we all get inspected and there potentially are different documentation expectations depending on who your inspection team is. This documentation requirement, we haven't tried to mess too much with it in 315. We've really tried to get you to think about what are the areas of judgment that, if you think about ICE 230, where the documentation requirements are much more explicit and detailed, it's saying if I'm an experienced auditor and I've had nothing to do with this audit and I come in and look at what you've done, would I reach the same conclusions as to what you've reached? And so it's absolutely professional judgment as to what gets documented in regards to those two questions. I know that's not the magic answer people want, but that's the reality. You have to think about where the judgments are that somebody else may not form the same conclusion or get to the same answer as you, and then think about whether or not that makes sense to document them. And the next question I'll just jump through quickly as well, Sylvia. This one relates to documentation as well, and really, am I going to have to document all of these inherent risk factors, for example, that I've got in there. And again, the intent is to use those inherent risk factors to help you identify the risk, and it will help you assess the risk. So for example, how complex something is will help you determine where it is on the spectrum of risk. But it's your professional judgment as to what gets documented. So if it's obvious, then I would say don't bother documenting it. If it's an area of judgment that another experienced auditor may not understand, then I would expect you need to document it. Paragraph 43 is one of the questions we got from this part of the world, and this is paragraph 48 is requiring the auditor to assess inherent risk by likelihood and magnitude. But when you get to significant risk definition, it's likelihood or magnitude, and this is absolutely one of the challenges that we have been grappling with. So paragraph 48 is saying, for risk of material misstatement at the assertion level, you need to assess those inherent risks by thinking about two things. You need to think about the likelihood, and then you also need to think about the magnitude. And how they work in combination helps you then decide where a risk is on the spectrum of inherent risk. When you get to significant risk, though, you've already decided, or you've decided all of those that have a high magnitude and a high likelihood, so the scary, scary risks. But you also now need to think about whether there are other inherent risks that may have a slightly lower likelihood, but it's still high magnitude, and decide if those two are also significant risks. So this is kind of the point behind that whole or in the definition of significant risk. And as I explained earlier, there are absolutely mixed views on this. We've asked a question in our explanatory memorandum for you to respond to, and please give us our views on what you think about, give us your views on what you think about that definition. As I said, I think I'm on record saying personally, I think that it should be and not or, and that would then fix this particular dilemma that we have as well. And then the last question is around, I promise you I am wrapping up, this last question, and then the way forward is all that we have left. But the comment here is that the flowcharts are very helpful, which I am thrilled to hear. And a question as to whether they would be included in the application material. And then a second question around some concerns around the length and the complexity of the standard and what are we going to do about that. So great that you think the flowcharts are very helpful. That is wonderful. We don't have any plans one way or the other at this stage to necessarily include them in the application material, but if you find them helpful and you would like them included, please say that in your response, because that would be very helpful from a direction perspective. We could make history by including flowcharts, I think, for the first time in a standard, other than the going concern flowchart that we have in this part of the world. And then on the second piece around length and complexity, this is something we hear a lot. I don't have a magic answer, and any suggestions you have will be gratefully received on how you think we can enhance the implementation of the standard. Don't just tell us the standard's too long, tell us what to cut out. Don't just tell us it's too complicated or complex, give us suggestions on what needs to be simplified and how we can simplify it. So there's a lot of comments that this is too long, okay, and then we say, what do we want to cut? And instead of telling us what to cut, they tell us they want extra material added. So that has been a real challenge for us. But if you have any suggestions, that would be gratefully received. So the way forward, as you know, the comments are due to be submitted no later than the November 2nd, which is a little under a month away. We can't be accepting responses after that date because we really will just run out of time to stick to the timetable that you can see on that little roadmap. So the comments will close on the 2nd of November. We are meeting as a task force the following week to go through all of the comment letters together and to start to work on how we will respond to this. It is important to respond, when you're responding to the questions, to say why you support something or don't support something. And that reason then helps give us insight into how we might deal with it or respond to it. But it also helps us when we compare other responses. So just saying you don't support something isn't overly helpful to the task force. The second bullet point there, if principles or concepts are supported, please state this fact. This is really important. If you like something, you need to tell us you like it. Otherwise, there's a risk we may inadvertently change it. So if we hear from 4 or 5 people or 10 people or 20 people that they hate something, but we know there are 70 or 80 people that love it, then we can make a decision. But if we don't hear that people love it and all we're hearing is people don't like it, we run the risk of changing something that you like. So please, if there is something that you love, please tell us. Something that you're supportive of or a change that you're supportive of, then we need to know that as well. That's really important. So I think we are finishing right on time, which I don't quite know how we managed that, but we did, which is fantastic. And I'm pleased to say that unlike last night where there was a huntsman spider I'd noticed above my head right before the webinar started, there are no eight-legged friends in my area at the moment, which is good to see. So no nervous moments for me during this call. So thank you very much for attending. The slides will be made available and the recording will be available next week. So for those of you who want to listen to it again, because you couldn't get enough of me today, or want to go back through some of the more detailed questions and answers that maybe you didn't quite catch, then that will be made available to you next week. So thank you very much for joining. Appreciate that it's been an hour and a half of me talking, and thank you very much, Sylvia, for helping me with at least raising the questions so you had a slightly different voice. Thank you very much and enjoy the rest of your day. Thank you.